Alright, so in the previous lesson, we talked about liquidity of your personal assets, how easily and completely your own assets can be converted into money. And then we left it at that, saying that there is another aspect of liquidity, which is the liquidity in the overall economy. How easily and how much money is available in the overall economy of the country or the overall economy or the market. You see, this first aspect, the liquidity of your own assets, is your personal decision. You have to decide how much will be the liquidity of your personal assets, where you are going to make your investments, and how liquid they are going to be. But the liquidity in the economy or the environment or the liquidity of the market is decided by the central bank of the country. So now we shall first try and understand what is meant by the liquidity in the economy and how it is controlled. And then I will tell you why you should be bothered, or rather why you and me should be bothered about the liquidity in the economy of our country. You see, you may ask me that we should be bothered about the liquidity of our personal assets. But why should we be bothered about the liquidity in the environment or the economy? We will discuss that towards the end. But before we talk about liquidity in the economy, we first need to briefly understand as to what is the fiscal policy and the monetary policy. Because unless we understand the fiscal policy and the monetary policy, or at least the meaning of that, it may not be very easy to understand the liquidity in the economy. Every country has these two policies. All right. So let us imagine or consider that this circle represents a country's economy. All right. And this economy is run or controlled by two different policies, but they work in tandem, supporting each other. One is the fiscal policy and the other is the monetary policy. They are two independent policies managed or controlled by two different independent agencies, but they work in tandem like the two eyes of a human being. All right. So, what is a fiscal policy? The fiscal policy is basically a prerogative of the government of the country, whichever is the ruling government of the country. That government decides the fiscal policy. But what is it? Fiscal policy basically concerns with revenue generation and expenditure. Every country requires money for its functioning. So, where does the money come from and where will that money go? That is decided by the fiscal policy, which is controlled by the government of that country. See, the government would require a lot of money, and where that money comes from, it comes from various forms of taxes, indirect taxes, direct taxes, your income tax, tax paid by the corporates, various fines, levies, penalties, and there are so many different forms in which the money flows to the government. And where does that money go? The government spends that money on various things like infrastructure, building roads, bridges, health care, then the pension for the people, the defense forces, all these things you see, the government has to spend money on that. But then what is the monetary policy? Monetary policy is the prerogative of the central bank of the country, whichever country you are in. If you are in India, then it is the Reserve Bank of India which makes the monetary policy. If you are in the US, then it is the Federal Reserve. If you are in Japan, then it is the Bank of Japan. Depending upon in which country you are, The central bank of that country decides the monetary policy. But again, what that monetary policy is? The monetary policy basically concerns with circulation of money or the liquidity of money in the environment or in the economy. That means how much money should flow in the economy. Like blood flows into your body, how much money should flow into the economy. We all know that shortage of money is bad, but at the same time, excess money is also harmful for an economy. If there is too much of money in the economy and not enough goods to be purchased, then the price of things will increase, inflation will increase. We have seen that in the first chapter when we were discussing about inflation and the types of inflation. We know that when money is more, the inflation will rise. All right. So this is basically a brief description of the fiscal policy and the monetary policy. Now let us see how the central bank of a country regulates the money or the flow of money or the liquidity in the economy. All right. We shall talk about the liquidity cycle. Now imagine a situation in a country where the economy of country is not so good. The unemployment rate is high. People are largely unemployed. The industry is suffering. There is no growth in the industry. Inflation is high. People are suffering. So the economy is not so good. Now, why should that happen? Why should there be unemployment in a country? There may be unemployment because the industry is suffering. There is no growth in the industry. The industries are not growing. So therefore, they are not able to offer employment. But why should the industry suffer? That is because there is no demand for the goods. People are not purchasing the goods. And therefore, the industries are not able to expand. They are not able to grow. They are not able to survive properly. But then why should there be no demand? Why should people not purchase? That may be because the inflation is high, the cost of things is too high. Therefore, people don't have adequate money and they can't afford to purchase. So that may be the reason. But ultimately, it boils down to saying that the economy of the country is not so good. So, in such circumstances, what will the central bank of the country do? The central bank will relax the monetary policy. What do we mean by relaxing the monetary policy? The first thing they'll do is they will reduce the interest rates. That means loans will be available to people quite easily. Industry will be able to borrow money from the banks quite easily. So when they borrow money, they'll be able to spend. Then the cash reserve ratio or the cash reserve rate, that will be brought down by the central bank. What is this CRR? It's one of the important things. I think we must discuss that before we proceed further. So the cash reserve ratio or the cash reserve rate is one of the most important tools of the monetary policy, which helps in controlling the liquidity in the economy. What is it? How does it do that? In simple words, CRR is that portion of the time deposits held by the commercial banks, which the commercial banks must keep aside with the central bank of the country. Quite a complex statement, a little difficult to understand. Let me explain that to you. What it simply means is, let us say that the CRR rate determined by the central bank is 6%. All right. So if CRR is 6%, that means out of every $100 being deposited in the banks, in the commercial banks, $6 out of that will be kept aside in the central bank of the country. That means out of $100, 6 go into the central bank. Only $94 are then available with the commercial bank to be lent to the borrowers. Whoever wants to borrow money from the bank, only $94 out of 100 are available for lending it to them. What does it mean? It means that a small change in the CRR will either infuse or withdraw a few $billion from the economy. How does that happen? Let us say the CRR rate is reduced from 6% to 5%. That would mean that out of 100, only 5 rupees will go or $5 will go into the central bank, and remaining 95 are available to be given out as loans. Instead of 94, now 95 out of 100 are available. $1 per $100. If you see it at the national level, a few $billion will now get into the system to be available as loan to the industries and to the people. On the other hand, if the CRR is increased from 6% to 7%, that means only 93 out of 100 will be available for giving as loan. That means a few $billion from the banks will have to be shifted to the central bank, and that money is not available to be given as loan to the public and to the industry. All right. So when the Federal Reserve changes the rates, there is a significant impact on the economy, and that impact you often see reflected in the stock markets. We'll discuss about that. So coming back to the liquidity cycle, when the rates are lowered, more money is available for giving out as loan to the public and to the industry. And the fixed deposits are no more lucrative. When people want to keep their money in banks and earn some interest, they would not prefer to keep that money in the bank because the interest rates have reduced. They would either prefer to put their money in the stock market, or they may rather spend that money and not put it in the banks because the banks are not going to give them anything. And therefore, when people start spending the money rather than keeping in the banks, then the spending will increase. Gradually, more and more people will spend, and people will keep spending more and more rather than keeping the money in the bank. So, when spending increases, the industries would grow. The industries would need to produce more, and they will grow. When the industries grow, they will employ more people, they'll expand. So, the employment will increase. And when employment increases, there will be more money in the hands of people. More employment means people will get more money. There will be more money available to purchase things. All right. And therefore, the spending will further increase. Got the point? How a vicious circle it is? And all these actions, which have been result of relaxing the monetary policy by the central bank, all these actions ultimately are a measure to increase the liquidity in the economy. The liquidity in the economy has said to have increased now. And what happens when the liquidity in the economy increases gradually to a level which is considered high? When there is too much of liquidity in the economy, then what will happen? The economy will get overheated. People will have a lot of money in their hands. Industry will have a lot of money. The demand supply mismatch will be there. People would want to pay more, buy more, but if the industries are not producing that much, then the cost of things will increase, inflation will increase. And no government wants that. No central bank wants that the inflation increases beyond a certain limit. So what will the central bank do now? If the economy starts overheating, then the central bank will again try to tighten the monetary policy. What is meant by tightening the monetary policy? The first thing they will do is increase the interest rate. That means the loans will cost more, the FDs will start paying you more. So loans will become costly. When the interest rate increase, the loans will become costly. And when the CRR goes up, more money will now have to be kept into the central bank. That much less money is available for dishing out as loans. So first of all, money available to be given as loan to the public as well as the industry will reduce. The interest rate on loans will increase. People will now start putting their money in fixed deposits in the banks because of the increase in interest rate, the FDs will become lucrative. So rather than spending money, people will now start saving money in their fixed deposits. Therefore, ultimately, there will be less money in the hands of people. When there is less money in the hands of people, people will buy less. And when people buy less, the demand will reduce. All right. And when the demand reduces, the industry will produce less. When the industry produces less, their expansion growth will get curtailed. And it is a reverse cycle of this. So ultimately, by tightening the monetary policy or increasing the interest rate, what the central bank has done is they have just reduced the circulation of money in the economy. All right, the liquidity is said to have reduced. See, the money in the economy may remain the same. Whatever $1 billion are there in the country, that may remain. The point is how much of money is in circulation, how much of blood is in circulation. If it is there in circulation more, then there is more vigor in the body. But if that money, instead of being in circulation, if it remains locked up in the central bank, then it is not giving that much of vigor and vitality to the economy. But there is a purpose for it. The central bank has to do it for reasons which I have just explained to you now. All right. So what happens when the monetary policy is tightened again? Then gradually a situation will come when the industries will start suffering, the employment will start reducing, inflation will again start rising. So this cycle continues, you see, and the central bank of the country has to constantly monitor these activities. It can neither allow the liquidity to increase too much, nor can it allow to strangle the economy. So the central bank, you must have seen always people keep talking about the actions by the Federal Reserve, how they keep controlling the liquidity in the economy. What they are actually doing is they are just controlling the money tap. They are either increasing the opening of the tap so that more money flows, or they are closing the tap so that less money flows. Or at times they are just leaving it as it is and letting it circulate. All right. So now the $1 billion question: why should you be bothered about the liquidity in the economy? Or rather, I would say, why should you and me be bothered about the liquidity in the economy? How does it affect us? You see, we have already discussed that when the monetary policy is relaxed and the liquidity in the economy is high, that time what will happen? Money is easily available to everyone, to the public in the form of borrowings, to the industry in the form of loans. All right. So the price of all assets will keep increasing. Though the intrinsic value of the asset may not increase, but the price being paid for that thing will keep on increasing. Why will it increase? Because people have got more money for the same thing. They are willing to pay more. Whoever pays more will get the thing. All right. Lot of money will flow into the stock market. The stock market will keep rising high, not because of the intrinsic value of the stocks, but because ample money is available to be pumped into the stock market. Money available at low interest rates people and industries can just borrow and pump it into the stock market for gains. All right. People are willing to borrow and spend at low interest rates, and industries are also willing to borrow more. So ultimately, because of this, what happens is, if you are wanting to invest your money in any asset like real estate or stocks and shares, then you have to be very, very cautious when the liquidity in the economy is very high. Because when the liquidity in the economy is very high, things will be available to you at a higher price. And it should not happen that you invest huge amount of money when the liquidity is at the peak, and then in a few months the central bank starts withdrawing the liquidity and the asset price start falling again. So when the central bank will reduce the liquidity, when they increase the interest rates, things will start falling again. The real estate prices will start coming down. The stock market will start coming down. All right. So therefore, when you are investing your money, you must have an eye on what the Fed policies are or what the Fed rates are. You must have often seen that whenever there is a meeting of the Federal Reserve, there is an impact on the stock market. If the Federal Reserve is easing the monetary policy, if they are reducing the rates, then the stock market rises in anticipation that more money will come into the stock market. And when the Federal Reserve tightens the rate, then the stock market will start coming down in anticipation that now a lot of money will be withdrawn from the stock market. All right. So especially when you are investing your money in stocks and shares or real estate, you must have an eye on the overall liquidity in the economy. So I hope the concept of this liquidity of your personal assets and the liquidity in the overall economy is now very clear to you. I am sorry that this lesson has become a little too long, but then I thought it is better to clear a topic and complete a topic at one stretch rather than breaking it into pieces. So please bear with me. All right.